Bloomberg Audio Studios. Podcasts, radio, news.
Single best idea on an interesting Monday as well. Nice eclectic set of guests as we all recovered from brackets blown up. Richard Truman, our producer, he's the one leading the charge here at Team Surveillance with a sprightly bracket, to say the least. Leading the charge today on equity discussion, stock market discussion, was Lisanne Sonders at Charles Schwab. She was absolutely brilliant in parsing out price-to-earnings ratio, the numerator and the denominator. Here, Lisanne Sonders.
You have to segment it. You're still in the mid to high 20s for tech or the Magnificent Seven. Then you get closer to 20. We've come down from about a 22 forward multiple to about 20. Then you can go equal weight or S&P X Mag 7, and you're into the teens there. So it really depends on how you segment things. The problem is that we've had a declining numerator and a declining denominator. As I mentioned, I think we need to see stability in the denominator part of the equation to provide a little bit of a lift from a valuation perspective. We're not quite there yet.
Absolutely brilliant. Bronze it. Here's the way it works, folks. Any given ratio, I don't care what it is. In the case of the vanilla price-to-earnings ratio, but it can be price-to-cash flow, whatever. There's a numerator, the number up top, and the denominator, the number down below. And they each have two ways it can go. Well, they can stay stable, but for the point of discussion, the numerator can go up or down, the denominator can go up or down, which means you have four outcomes. And instead, what you hear in the media constantly is a single static number analysis. Pros like Lisanne Sonders are always looking at the dynamics. You'll hear the phrase partial differentials, which is fancy calculus talk about the movement of those four outcomes in the numerator and in the denominator. With us today, Joe Lavorgna of SMBC Nikko. Joe, with his experience with Lawrence Kudlow in the first Trump administration. Joe Lavorgna talking here about the unemployment rate.
We tend not to look at other economists, in part because we don't want to be biased. But to get a higher rate, Tom, we'd have to be really pessimistic on growth. Also, too, Okun's law is useful, which is, you know what Okun's law is, but it's the relationship between potential GDP and what actually happens in the economy. And the other thing is this, is that even if we had a slow period of growth this year, maybe you talked earlier about the pain. Yes, we're going to have somewhat of a pullback on the fiscal side. Secretary Bessent mentioned detox. But if all of a sudden it looks like 2026 is going to accelerate, financial conditions will ease in anticipation of that. Hopefully there'll be some clarity on the tax side, and companies wouldn't lay people off. So there'd be no reason for the unemployment rate to rise if the 12-month forward was improving.
Joe Lavorgna, SMBC there. And I really want to mention a research note, a side research note that came out today. Torsten Slok at Apollo Global with a blistering 2 paragraphs modeling out what we're all observing, whatever your politics, is the decline in immigration. At Apollo Global Management, they model out a new run rate of 60,000, 60, on non-farm payrolls. That is a shocking number, bringing it down from the conventional 150 down to maybe 120, and now well below 100,000 per month on non-farm payrolls. That is just an amazing 2 paragraphs on the changing of America. On your commute across America, look for us. Good morning, 99.1 FM Washington, 92.9 FM Boston. Good morning on Apple CarPlay. On YouTube, we're out. Subscribe to Bloomberg Podcasts. And on YouTube Podcasts, it's Single Best Idea.